really interesting session this morning. We're going to be looking at the transforming European real estate. So picking up on aspects like ESG, digitisation, technology, investment. But we're just going to start with a kind of brief presentation from Thomas here, looking at the economic impact of Russia's invasion of Ukraine. And I know this is a sort of draft piece of research, but really interesting that this is being shared with us. And I'll also share some of the views as well that came from our recent CE summit yesterday in Warsaw, just so that we can also pick up on that aspect of it, because for sure geopolitics is something that is going to be transforming real estate as well. So over to you, Thomas.
Welcome, my name is Thomas. I'm a partner located in Frankfurt, leading the real assets industry in Germany, also part of our EMEA and global world. And I will just give some fruitful thoughts for the discussion later on this geopolitical impact of the invasion in Ukraine, which will also impact, let's say, general trends we've seen before. And I think the key messages on a macroeconomic base, it's not real estate specific, it's across all industries, is that after the, let's say, pickup in the economy we have seen after COVID, starting last year, fabulous growth rates in most economies. Of course, now with the invasion in Ukraine, we will see numbers later on. We will have a bit of a slowdown in the general economic environment. That's something we will see. One impact is, of course, the significant increase partly in commodity pricing, also in food retail, but also impacting more real estate is construction costs partly. We will also see some statistics significantly impacting current developments that are going on. We also already see some mezzanine lending, some construction sites really struggling across Europe based on that. Of course, also combined with the challenges in the supply chain, which we have to refocus in each industry, but specifically also in real estate. In the initial discussion with our strategy and colleagues, I said, well, real estate is always located. It's not moving. But if you look about or think about supply chains and labor, etc., it's partly affected by the supply chain changes, but not as much as like the automotive industry. There we have significant changes. Trade flows, it's also not so significant for real estate, but more on capital flows. So looking forward to the discussion, what also Natalie and the other participants will share, what we see in changes. And of course, the evaluation overall, we will see new blocks building up, east-west again. That's our best guess we can show from today. Just flipping through the other slides, sticking to the 10 minutes, it's in general the overview, just picking out this world map, the key trade indicator. It's a sentiment on economic outlook for the next 12 to 18 months. If you see the world map, as darker it gets, the worse it is. So it's Russia, France and Portugal, which is the most negative impacted sentiment by this key trade indicator. You also see some increases in Australia, in the Middle East, but overall the big, large economies are negatively impacted by this invasion, and the sentiment on the economic outlook is negatively impacted. And also in the financial market, you can see that the risk curve is opening, the gaps between developed and emerging markets especially. So there is clear messages that also in the market the risk is increasing, and the sentiment is going in the wrong direction. So on the next page, Richard, just to pick up, also here growth rate, if you look at the European Union, I would guess including the UK, we had last year 5.1% growth, and in January the expected growth for this year was 5%. Now it's reduced in the new scenarios down to 2 to 2.5%. So a significant downturn even for this year, but also for the next year compared to the growth rates in general on the GDP growth we expected at the beginning of the year. Perhaps on the next slide, I don't want to go into detail. If you look what's the impact on the specific countries and region, if you see, of course, everything that's red, which is closer to Ukraine and Russia is, of course, more impacted. It's the Baltics, the Eastern Europe parts. So looking forward also, I don't know what you heard in Warsaw the last 2 days on that, but if you go to the Middle East, Japan, US, it's greener, but still impacted by the energy costs that are significantly increased. We analyze this, the different industries under different scenarios. So the less relevant is a swift conflict resolution as well as a global military escalation, hopefully. So we see the most relevant scenarios as a accelerated deglobalization, especially on the supply chain side, the Iron Curtain reloaded, we call it, as well as a global polarization. So that's in the middle, the scenarios we expect to be the most relevant and also we used in the study. So on the next slide, please. So we analyzed each industry under three, let's say, transmission channels. Of course, what's the impact of the changed commodity prices? What's the impact of the supply chain changes? And what is the change of the trade flows and especially also capital flows? And then going now to specifically real estate, what we see as trends on the next page. Although that's inflation, of course, it's a topic I don't have to go into detail. We all know it's significantly increased. And if you see at the bottom, it's especially driven by the energy prices. Yeah, so if you have 40%, if you compare February to March expectation, the energy prices as well as the consumer price indices, these are driving the inflations currently in all markets across the globe and will also have a significant impact on real estate. We will have potentially discussion, is inflation good for real estate investments or not? I've seen some statistics. I think there is not a clear message, but for now I understand it's not negative, but also not too positive. Exactly, these are the general results on the industry. Again, real estate in the middle, it's a medium overall rated impact of the Russian invasion, all these changes we will see in the next years. But as you can also see, other industries that are also indirectly, of course, a challenge or are a challenge for us because all the other industries are our tenants at the end of the day. So we say, okay, real estate is good, but if you see automotive, industrial, manufacturing, chemicals, these are all potential tenants in our buildings. So there will be an indirect impact. And going on the next slide a bit deeper into it, just some thoughts we said on the commodity prices. We differentiated between the construction area as well as the investment area. I think the commodity price increase and especially the challenges on the supply chain will have a significant, or are already having a significant impact on construction. As we see wood, steel and cement prices, we will see on the next page in a minute, we have increases 20, 30, 40% of the specific materials. On the investment side, it's more the impact of the increased interest rates triggered by the increased inflation rates. There might be some changes as we all know, most of our investments are levered, or highly levered, not so much, but levered at the end of the day. So a significant increase in interest rates have an impact on our real estate pricing, of course. I said supply chain. We are currently seeing that forward purchases for developments are deleted or cut back now. We see first mezzanine loans facing some challenges across Europe. So we see some expansions and discussions. And of course, if you need 1 or 2 more years on the construction side, we all know it costs, because financing is not cheap, it costs you 8-10%, whatever your financing structure is, and it works directly against the profitability of the project. So that's, I think, the key challenge we will see in the next 12, 18, 24 months. And also one impact, as we will also discuss digitization and innovation today, I think it's on labor, especially in the programming side, the software developer. We know that lots of people are in Eastern Europe, in Ukraine, in Russia. So again, supply chain challenges. I'm really looking forward to the discussion, what we see there. But overall, we see it's a medium impact, less on the investment side, as also Russian capital was not so relevant in the European or the global market. It's there, but it's not, let's say, a significant role they play. The construction side, I'm a bit more negative currently. But in general, I think we as an industry, real estate industry, will not have the hardest hit compared to other industries. As I said, if you compare the construction costs for some cement, timber, concrete, if you say there's partly significant increases in prices compared 2021 to 2022 as of today, and there will be more increases, and that will increase directly construction costs, works against the development calculation. So that's really, really a key challenge. It's the price and it's the availability of material currently in renovation and in new construction. So that's, I think, the general overview. Thank you, Richard.
Thank you. Thanks very much, Thomas. Super. And I mean, interestingly, picking up on the view from Warsaw, there were different views about whether it would be positive for Poland or not positive, and I'll go into that in a minute. But let's just do some quick introductions for those that don't know me. My name's Richard Betts. I'm the group publisher at Real Asset Media, and we do around, I don't know, 60, 70 of these events probably a year. Just online for the past 2 years, I guess, but now coming back in person and hybrid. So thanks very much for joining us. Thomas, quick introduction of yourself, and then we'll work our way around.
Yeah, Thomas, partner in Frankfurt, leading the real assets industry in Germany, and I'm a deals person, so worked for more than 25 years in deals, in restructurings, etc., leading a team of 450 people, industry-specific colleagues in Germany.
Great. Natalie.
Thanks. Natalie Breen. I'm Global Head of Strategic Growth and Business Development at Sanne. Sanne is a listed FTSE 250 fund administrator and company secretarial services provider for alternative assets. So we're doing a lot, obviously, in the private equity space for real estate and renewables, as well as other alternative asset sectors. So thank you for the invitation.
Great, thanks. Kingma.
Good morning, everyone. My name is Kingma, and I'm the head of UK for PropTech One. PropTech One is an early-stage venture capital company that focuses on investing into European early-stage, mostly seed and Series A technology startups that impact the built world. We're headquartered in Berlin, and I set up our London office, and so we're very active now in the UK market too. My background is that I've worked in software engineering and product management for about 5-6 years before going to VC now for about 3.5 years. Thank you.
Perfect, thanks. Christiane.
Yeah, Christiane Conrads. I'm a local partner at PwC based in Frankfurt. I recently relocated back from London to Germany. I lead the EMEA Real Estate ESG group at PwC, which is basically an interdisciplinary team consisting of consultants, deals experts, climate experts, lawyers, valuation experts, and we help our clients develop and implement ESG strategies. Great,
thanks. Let's pick up a little bit on the geopolitics and the impact on the real estate side. Certainly from the view in Poland, yes, there was a positive view in terms of, I guess, how lots of businesses who were previously set up in Russia or in Ukraine would therefore be moving their offices. So in terms of corporate locations, a lot of people would be moving particularly to Warsaw and to Poland. And that you've also got a large influx of people at the moment. That's women and children mainly, but ultimately there's an expectation that obviously a number of people will go back once that situation hopefully is solved, but also a lot of people will remain. And so there will be, there'll be a bonus in terms of additional workers, which was something that was missing, particularly from the Polish side. And the people also in Romania were seeing again that they would probably have, Ukraine, Russian businesses setting up there as well in Bucharest. On the sort of downside of that, the view was that you've again got potentially huge inflation coming in into Poland, maybe even as much as 15% towards the end of the year, and that's bound to then have a negative impact in general. So you've got those kind of two things balancing one another, really. But in terms of the real estate transaction side, although I saw that PRE had something saying transactions were down significantly, what they were saying was that capital flows there, a lot more intra-regional money, but also a lot of interest from US, particularly at the moment for Romania, was coming up, and also for Poland. So that was interesting to see, I think. And I can pick up on some other views as we go along. But Natalie, it'd be interesting to get your kind of sense of what you're seeing from the capital flows side.
Yeah, so I suppose from my perspective, it's more anecdotal about what we're seeing our clients set up funds for. Obviously, as a fund admin provider, we have kind of early doors look at their strategy in some ways, because we're obviously setting up their funds, etc. And we're also seeing what they're investing in, plus just being involved in some of the local discussions here. So I think there's a couple of themes. So I think coming back to your point, Thomas, like coming out of COVID, we had the COVID issues, and like we had probably a looking more at resilient assets. So people were very focused on logistics, beds across the whole spectrum, and I might touch on that in a bit more. So that's everything from, student accommodation to PRS, to build to rent, to affordable housing, social housing, and senior living. So there's been a lot of, as seen as a defensive move across that last 2 years, and we've seen a lot more groups look to increase their investment because of the stabilised returns you get out of that. And then there was a kind of a look towards meds, so medical facilities, not necessarily hospitals, but more like warehouses that may have even startup farmers and things like that. So but that's quite a small niche market, and obviously data centres has been very sought after, but again, there's not so much supply, and you may have to construct them in some areas. And I think on office, we saw clients, the whole, work from home, and I'm sure we'll talk about that when we get to ESG and other things. But I think clients are definitely now looking at their office assets, and basically from what we can see is, there's a trend towards maybe reducing assets, and I'm not the expert on the numbers and forecasts, maybe reducing premises space, but going to their better space rather than actually, and having the gap between, premium kind of office towers, or, like office towers like this, and the secondary market has widened because of the ESG impact of, you just can't tart it up to kind of greenwash it. You've actually got to really put the effort in and reposition that property from it, because that's what tenants now want, is we've all got carbon net zero targets, and that's reflecting in their premises. So we had this issue, but now with Ukraine, it was interesting. I was at another session earlier this week, more focused on build to rent. We had a lot of big global players in that room, and they were looking at the whole spectrum. And what was really coming out is the tension now on development costs, and it's not just projects that are in play at the moment, which obviously are coming under attack, coming under pressure, but also it was all about actually who's wearing the risk of cost increases, because most of these contracts with principal builders, they're probably fixed, you go for a fixed contract. But that is now what the group was saying that was there was actually they're now building in potentially reviews and uplifts, because no one can sustain the increases on building costs. And so the question is, well, who's going to bear that? Is it the developer? Is it the investment manager? Is it the ultimate investors? Is it the ultimate end user? So I think there's a lot of that discussion, and if you conflate that with what's happening in interest rates, I think from certainly it seemed the general position on these BTR developers more so. The position was there's a trend towards stabilised assets, or the other thing which I thought I hadn't really considered, but it makes sense, is repurposing existing assets, because some of the most expensive parts of buildings are the steel and everything. So if you already buy a building that's got all of that, some of the more expensive inflationary costs already into it, and you're just refurbing other things, it may be cheaper. So it was definitely, I think that no one really had a clear measure on, 5-year horizon at the moment. I think for the reasons you say, it's too many moving parts, but certainly risk averse on development, or at least working out exactly who holds a risk and who can take that risk.
Yeah, and that was definitely a view that was shared in Warsaw as well, in terms of that risk. In fact, one of the investors said that, if anything, now is a good time just to sort of sit on your sofa and watch TV for the next sort of 6 months and see what happened, because there were so many unknowns in a way. One of the other interesting things which seemed counterintuitive, certainly sitting from London, was that at the moment they were saying into Warsaw that you've got 10,000 refugees coming in, but actually 20,000 going back every day. So you've got a real swap over at the moment, which was interesting to see. The other thing, and this session will be online over the weekend probably, but Marek Matraszek, who's a sort of geopolitical expert based out of Poland, was also saying, in terms of the renewable energy side, that although there's a lot of focus on the Polish government making strong remarks about coal and those kinds of things, that actually the rhetoric may be very different, and in some ways they will have been done a favour by the gas being shut off by Russia, and that there'll now be a big drive in Poland for renewables. And so, oddly enough, it could be that suddenly Poland will be leading the way in terms of renewable energy, as opposed to being viewed as somebody who's, heavily reliant on coal. But maybe just picking up with you, Christiane, in terms of the ESG side, how you think that's going to, maybe how this geopolitics is potentially going to be influencing that.
I think what you just mentioned about Poland, that's probably true for the entire European Union. So that, and basically focusing more on alternative renewable energy sources, trying to meet the Paris Agreement climate targets. But speaking to our colleagues, for example, from the US, they told us that in the US the approach is completely different. They now, I think, due to the crisis in the Ukraine, look forward for more oil and gas solutions over there, and trying to dig even more oil fields. And I think also I heard the same about Norway yesterday or something. So basically, I really hope that the European Union will continue with its leading role here, and maybe even before the crisis, you could say that the European Union, with the Green Deal, the Fit for 55, and all the various regulations, the taxonomy, the SFDR, has developed a giant comprehensive framework for which shall support the climate targets by the Paris Agreement, but also the achievement of the sustainable development goals by 2030. And what we understand also from our colleagues in APEC, the US, is that so the entire world is basically looking at Europe and see what of the solutions developed here can be used as a blueprint there as well. So, and just one last example from the US. We started to support our US colleagues now, and also an ESG project for a large American bank. And it was really interesting to see that they have developed their own taxonomy. And they were asking us, so how could they further develop their taxonomy? And I say, okay, why don't you look at the taxonomy already implemented by the European Union? So that maybe gives you some ideas and saves you some work. So.
I would like just adding a bit to that from a GP perspective, because the GPs are largely our clients that we deal with in that kind of sector in asset management. I think what's very interesting with the SFDR regulations coming in is we're seeing practically now how some of our particularly global clients who have real estate investments across all the regions, they're having to actually obviously grade their current funds to, now I'm not the lawyer on this bit, but they're either going to be like a Section 6, 8 or 9. And we can see that they're having active discussions around, because they've got common LP investors in a number of these funds. So it's also, how are they going to, so are they going to say to their LP investor of Fund 1, 2 and 4, actually, these ones are just a 6, so no SG there. And these are like the 8 or 9. So again, are we going to see kind of best practice come to the, and so you'll see more kind of upskilling and like buying assets that do come into more of the 8, because otherwise you're telling people it's this one's 6. Now it's historically been 6, but I'm just wondering if that doesn't set a trend for raising the benchmark. And also, if you look from a global fund manager perspective, it's a bit like, I think it's a bit like other regulations that we've seen where they'll adopt best practice. The EU's best practice, so they'll probably start, and I'm just wondering if this will happen, but they'll start adopting it in the US and APAC, because they're reporting to the same, a lot of them have the same LPs globally. So whether that will whether that will actually say, okay, we'll just adopt best practice, because a lot of the reporting, and we're seeing it from a fund admin perspective, we have our own ESG reporting tool, we have other, we can talk about later, digitalization in relation to what people want and real-time access to data and automation, etc. But we're seeing even from kind of our clients, they're wanting solutions around how they're going to report this. They're going to, it's making us, obviously, we have to put different business operations, and we've also invested in ESG technology for a few years now. But certainly our clients are having to put a whole lot of internal operational control to report this now. And the big players, the big PE funds, but they'll have this sorted. But there's a lot in between the big ones and the smaller ones, and there's a cost associated with compliance. So, so I just kind of make that point that I think we're going to see driven a lot more across globally from what's emanating in the EU. And I was just going to make one other quick comment. So one of the, and I'll never get this right, but it's you'll know it, it's the Pact of 71 institutional investors. Let's just get my numbers right. US 10.4 trillion assets under management. And that is it's called the Net Zero Asset Owner Alliance. And you have to align portfolios with a 1.5 degrees scenario and etc. But it's a commitment made by 71 of the biggest real estate funds, sovereign wealth funds. So one of our groups, speaking to Allianz, they're one of the founding members of that. But that means that when they're making investment decisions, like anyone who's signed up to this pact, they have to look at the ESG. So it has to go to the investment committee. So it is impacting investment decisions.
And do you think Europe is definitely viewed as the sort of gold standard versus APAC? Yeah. And so everybody's going to be coming up to a European standard?
Well, you know better than me, probably Christiane, but Europe is actually the only one that's really regulating at this level. I mean, Australia has done it through the Neighbours program, but that was back in the 1990s. But I think it's really here, isn't it? That's the impact.
It's here, and it's really what's happening. It's being put an end to greenwashing, and now it's super complex and comprehensive. And what the EU is doing is defining every bit of it, which takes time. And I think that's, as Natalie said, I totally agree. It won't be implemented completely, like 100%, also in the US and APAC, but it will make a significant impact on the regulation and also the approach there.
I think it's interesting, actually. I mean, I've read online that, yes, Europe has, in terms of percentage, the most ESG funds. I think about over 1/3 of European institutional funds now are labelled as some article of SFDR policies. But in terms of volume, it's still actually quite equal to America. So I think America, there's less than 20% of funds which are, in some ways classified as ESG. But obviously, America being a much larger market in terms of AUM, in terms of investment than Europe, it actually equates to quite similar as well. And also, just to follow up on your point as well, we are actually an SFDR Article 8 fund ourselves. And as a 50 million venture capital fund, we're relatively small in the real estate private equity game. But yeah, it brings us our own kind of interesting operations when it comes to asking our portfolio founders and CEOs of the companies that we invest in to report their ESG data too, and it definitely brings us more attention as well to institutional investors.
And what led to that decision, Kingma? I mean, was that was it a policy decision in terms of the business, i.e., how you wanted to run the business, or was it because you were, because that was a different way of accessing capital, or?
Yeah, strictly market demand, and plus the fact that we had the practical means to execute it as well. We invest in pretty early stage founders, and so it's really important for us when we do make an investment decision on any startup to build a very strong relationship with the founding team as well. And part of that relationship building, and therefore offering term sheets as well, is to open up a dialogue about what we expect to see from our portfolio founders, meaning that when we sign on term sheets, we also write side letters as well to ask them to report measures such as what's the gender ratio, for example, in their management team, what's their scope 1 and scope 2 emissions as well. It's relatively easy, to be honest, for a lot of these software companies, because as you might imagine, many of them is just a small team around a small office as well. Obviously, when their operations scale out, it gets more complicated, but by then they should raise more funding as well, in which case they'll have more resources to go to experts such as yourselves to get professionally audited.
And I suppose, what does this all therefore mean for the investment side? Because certainly from discussions I've been having with investor relations, capital raising, that everybody, that really raising for a capital, for a 6 fund just isn't going to work. It's got to be 8 or 9 really. And then if you've got the sort of SFDR requirements, does that change people's perspectives, Thomas, in terms of the types of things that they're going to be investing in, and to the exclusion of others, for example?
Yeah, definitely. It's triggering the investment decision if you define your fund as an Article 6, 8 or 9, and even if within Article 8 we have differentiation, we have 8+, etc. But that's something which is still early stage. We see some large investors that are clear on we want a building certificate, a high standard. That's important, but it's not enough. Yeah? Some of the union of the world, they are doing much more. They want a social impact, etc. But that's the key point. How do I really measure? And Christiane is better on that to talk about it. It impacts the investment, but it pushes money and investments into a market which is already limited. Yeah. So, but Christiane, you can comment better on the relevance on the investment side.
So it's even required, if you have an Article 8 fund, then it's already required by law that you disclose your investment criteria, and you need to decide which assets you are not going to invest in. So as Thomas says, it's.
I actually think it's quite good for investors because it's putting everyone on a level playing field, because they've actually got standardized terminology that you're using to measure and report. So actually you can judge like for like, because I think it was trying to prevent some of this greenwashing that was happening in the market. But coming back to investment decisions, I also think if you look at just tenants in your building, a lot of them have like net zero carbon targets themselves. So it's everyone from the end user to the LPs themselves who made pledges that they're going to be investing in net zero. So it's kind of like pressure from all different angles. And this is the kind of direction of travel. I don't think it's going to slow down. It'll probably accelerate. But then that comes back a little bit to what Minday said, which is about data, because that's what it ultimately comes down to. Because you have to actually have that data to be able to report it. And how do you collate it? Because it's going everything from the building, like you might be using Yardi or one of those systems, and it comes through the whole. If you're in a fund system, we also have obviously portals and things that we supply clients, but it's actually aggregating all of that and being able to report it. And that's not just, we need technology for that, and you need investment into that, which I think is maybe what you're seeing. I don't know, people wanting like one data lake. We've seen that out of COVID, that basically people wanted access now to real-time data. Like investors just don't want to have to wait for their quarterly statement that was normally done on Excel or whatever. They want kind of real-time portals. And with us in this industry as a fund admin, we co-invest into some of the technology platforms, and we've done a lot on that area. But do you see that? 'Cause we see
on the topic of ESG data within the built world, I mean, we see a lot of technologies from data collection, for example, IoT sensors and smart meters, to data aggregation and reporting platforms for investors and other stakeholders to view and to be able to analyze as well. And I do attend quite a few of these real estate ESG conferences, and it's really interesting to kind of hear how many professionals in the sector, senior leaders, are talking about the importance of reporting to various different frameworks as well. And I think that's a really important start. However, I think what's even more interesting as an opportunity, really, and as a kind of topic that's discussed kind of less, is really understanding the life cycle analysis of a property from the pre-construction phase. So in fact, starting from planning, I guess, to construction, to post-construction as well. And I think the nature of real estate assets, because they're of course different asset classes, there's different jurisdictions, and therefore different compliance rules and laws as well, and different forms of ownership, means that ultimately there are some real estate assets that are much easier to measure than others as well. I think what's kind of particularly interesting is that once we move beyond essentially looking at data and collecting data, the technologies are going to make the most impact in terms of improving sustainability, reducing greenhouse gas emissions of the entire life cycle of real estate will really come from hardware. So these will be coming from essentially engineering solutions, coming from material sciences, coming from logistics, coming from chemical engineering, so especially in terms of battery technologies and other forms of renewable energy, where energy can be stored more efficiently as well. And this is, I think, where venture capital can really play a huge role in this as well, combining with industry too. On the demand side, of course, with technology, tenants, we talked about, want better experiences, and many tenants are becoming more aware of, the greenhouse gas footprints of their own real estate operations, be it an office or be it a logistical warehouse or be it a manufacturing plant. From investor side, of course, all investors want higher returns. So that means understanding margins, understanding which technologies can reduce costs. And from a global perspective, of course, all of us want to see a reduction in greenhouse gas emissions as well, and have set various targets to achieve that too. And so I think with that on the demand side, and with the supply side as well, I think what's really interesting is about PropTech specifically is that when we look at technology impacting real estate, we're looking at technologies that will really forecast essentially how the future of work and the future of living will be, meaning that, what we see is that essentially employees are staying less and less time, spending less and less time in corporations for a long time. There's more opportunities now to essentially start a business if you have a good idea and you have really good means to execute it. The barriers to entry, the cost of capital essentially to initialize a startup is lower and lower. And so this means, I think, from an industrial point of view, that there's actually more collaboration between corporates who have the means, who have access to that capital, access to supply chains, etc., to access to distribution channels, along with startups who require those resources, but ultimately have the IP, have the patents to be able to create these technologies as well. And so as a venture capital investor, that's very exciting. Essentially, there's more opportunities to invest fundamentally, and it also means there's more opportunities to deploy these investments that are improving the sustainability of the built world across channels by speaking to the largest real estate developers, by speaking to the largest real estate owners in the world as well.
Perhaps one comment on the venture capital side. I think it's my gut feel that over the last 2 or 3 years in Europe, we developed more and more a venture capital culture, which was not there before.
Yep.
Perhaps more in London, but on continental Europe, definitely not compared to the US. And now it's growing. And one interesting trend I see is that PropTech venture capital investment are more seen as a part of the real estate allocation. So it's part, and that's really a new trend, because as you see in your investor base, you will have more and more classical, let's say, LPs in this fund. I think there's room for growth, but room for great opportunities as funds will grow. And I assume that your second fund will also be significantly larger, as we now seeing first 100, 200 million exit transaction in the PropTech market. The US is further there. There's so many multi-million and unicorns we've seen, but Europe is developed, and I see this as a great opportunity in continental Europe to support, because we have so much smart people here in Europe to support this venture capital industry growing, coming perhaps to the same level or a bit smaller than in the US. That's a great opportunity within the real estate space. It's not venture capital itself, it's part of real estate. That's really interesting.
Absolutely. I mean, speaking about the US, there have been significant news actually in the last 2 or 3 weeks alone. For example, Stripe, Google, McKinsey, they launched a joint fund of $850 million just to invest into DAC, direct air carbon capturing technologies. There was a Swiss company called Climeworks that raised $650 million backed by Partners Group as well, again, deploying DAC technology. DAC is a real estate topic. Ultimately, it requires land, it requires real estate to be built upon as well. And these can be deployed specifically into the buildings that are generating energy or consuming energy too. Similarly with heat pumps, similarly with concrete and cement technologies too. These are all real estate and construction conversations as much as talking about technology as well. And so I think Europe, we've had a discussion already that it's really got the best framework and probably the most market awareness in terms of the importance of distributing sustainable technologies as well. So, we see US ahead, but I think we'll catch up quite quickly, quite soon. Exactly, yeah.
And you're obviously at the sharp end in a way, because you're investing in the early stage.
Yeah.
So I guess, what are the types of things that you're investing in terms of your strategy? What are we likely to be seeing?
Yep.
And is any of that technology kind of disruptive, if you like, in terms of will be changing and having a significant transformative effect?
Yes. So as a venture capital investor, we've made 14 investments so far, and when the partners Nicholas and Anya set up PropTech One, it was really to tackle 3 key themes within real estate, which of course have grown substantially in the last 10 years and will be expected to grow. The first one is in terms of digitalization, right? So everything is becoming more digitized in terms of data, in terms of our processes, in terms of our management. The second part is about customization as well. So what we've seen with COVID, especially with offices, with retail too, is how do landlords, how do real estate managers adapt their existing fixed assets to meet changing demands and changing needs. And the third part, and this is part, of course, the subject of today's conversation, is really on sustainability too, which is such a broad topic. So the 14 investments we made have been split across these three themes, and we will continue these three themes across the further investments we make currently for our existing Fund 1 and of our future funds as well. In terms of what we look for, of course, as a venture capital investor, we look for returns too. And so that means we're looking for differentiating technology that is very, very defensible and very, very, very impactful too. So we touched upon ESG data collection methods and reporting platforms as well. And of course, they will be increased in demand, driven by regulation, driven by reduction in cost as well. But ultimately, many of these platforms are kind of harder to differentiate as well. So this is why I think as an investment opportunity area, it's actually rather more exciting to look into the hardware solutions where they have rich IP, where they have where we have professional expertise and advisors on board who can actually guide us on the practicalities of deploying this technology and researching this further. And because of regulations, because of changing requirements and demands, they will be expected to scale significantly in the short term.
Maybe one comment on the regulation. So what we see now is also with the EU taxonomy, without smart digital data collection and management tools, it's just not possible to be taxonomy compliant. That's also with many clients we see first saying, okay, let's be 100% sure, let's go with the gold standard, which basically is the EU taxonomy. And then now we need first to focus on our digital tools and tools before we will be able to collect the required data.
Yeah, it's interesting. As an asset class, VC has grown in year on year, and even though in the last couple of days maybe you've seen some tech shares such as Netflix, such as Facebook, Meta, it's a very different game, I think, in the kind of early stage investment field, and so many of the VC funds, particularly in the US, but also increasingly so in Europe, are so large to the extent that they are market makers, right? So with digitalization platforms, often you have a really, really strong team and a very good product development focus. How do you compete? How do you get in the market? You need to have capital to be able to employ more, to be able to invest more in marketing as well. And so that's why I think it's really crucial for the VC partners and VC principals who are leading on deals to be building up very good relationships with the founding team. If they have complete trust in terms of the vision, in terms of the ability of the founders to execute, then there will be capital deployed, and then those companies which gets invested very significant rounds with Series A, Series B, Series C, etc., will be the winners ultimately too.
And I suppose, where are we in some of these, discussion around transformation? But in a sense, one needs to know where we are, where we're heading, and how prepared is everybody for that. So I suppose, where are we on that journey at the moment? I mean, for let's start with ESG perhaps, and then it'd be interesting to pick up your view as well, Natalie. But so Christiane, I mean, where are we? Where are we heading? Is everybody ready for it? I mean, have some people not got on the bus at all? Where are we?
Yeah, I think we are still at the very beginning, and we're now understanding how difficult and complicated it is, and kind of a trial and error approach is taking place. So what we see is that the institutional European investors are basically leading the game. So they're prepared, but they started already preparing 15 years ago or even longer. So, and we see then other, maybe not the funds, but other real estate and investment companies, they see the different stakeholder demands that Natalie mentioned from tenants, from buyers, and also the increasing regulatory requirements, not only by the sustainable finance regulations, but also on energy efficiency, for example, requirements to use renewable energy sources, all as a consequence of the Fit for 55 regulation, which is happening in parallel to the sustainable finance regulations. So they see that they are not that prepared, and you helped us with the projects, so it's big change management skills are required there. It's a different approach. So all the different teams, also internally, the processes need to be adopted, and that takes time. And I personally think also when you look at the regulation, it will get more complex and unharmonized before it gets better and finally a framework is adopted.
And I mean, how do we manage some of this? I mean, so for example, one of the interesting things about the discussions in Warsaw around the ESG side was, of course, because the majority of buildings there didn't exist and so had to be built and are therefore relatively new. But if you look at Germany or France or London here, how many of the buildings that exist at the moment are going to be ESG compliant? And it's discussions up from 60, 70, 80% of them will be counted as non-ESG compliant. And so therefore there's a very big task in terms of transforming that. It'd be interesting, Natalie, to get your view on that, and also whether or not there's funds being specifically set up for that. I know there's beginning to be moves in terms of financing to help finance it, but...
Yeah, so I think coming back to what Christiane was saying, what we're seeing from our clients, so if we take our kind of big kind of PE global funds that we do work for, a lot of them have been planning for the last 10 years or so. They have built their own in-house ESG requirements, reporting tools, etc. So they're really leading the way because they've got the size and the resources to do that internally. I think the gap there, I think there's, once you get below that kind of the top big global institutional players in real estate, I think there's a lot of other groups that need support, right? And I think it's coming up to, you need to spend money to put systems in place for all the reasons everyone's discussed. But of course that will pay off in the long term, but there are compliance costs in putting in having to comply with these regulations. So I think that's where we're seeing us as a service provider, probably PwC sees it the same. These kind of groups, that they're not going to pay for their own tech system. They're going to have to use someone's that's existing. So I think we can really support our clients that have, with our kind of solutions that we all have to give support around that reporting, etc. But I think coming like around the globalization of it, if you think about it, if I'm an investor in some PE funds, in some funds here in logistics, say, and I'm an LP investor and I want all of this reporting, and as an LP, I have my own net zero carbon requirements that I've got to report, and now I'm going to invest in a Japanese logistics fund, I'm probably going to say to that GP, I know you don't have to, but I'm going to need that data because I've got to report it to my exco to make that decision. So I think you're going to see it driven by investors and also, as I mentioned, the end consumers, the tenants, saying, well, hang on, if I lease this building, coming back to your point, I need to report my net carbon, so I need to lease a building that's sustainable, meets criteria. So I think you'll see it from that. And coming also back to some of the points raised, employees only want to work for, like young employees, well, even all of us probably want to work for groups that have made that net zero carbon pledge and other things. And that's becoming really important to retaining staff, making sure you've got sustainability policies in relation to, staff is quite short in the professional services. So again, it flows through the whole system, and I think I don't know how long it will take, but I think it's on its way, right, in other areas.
I think on that note, and I think Thomas made a really wise point earlier talking about culture. So I think the challenge with sustainability and also with systems and technology as well is that they're both very technical subjects when you get into the details, and so it requires a good grasp of understanding, what are the exact measures, what are the exact components, right, of all the various solutions we can adopt in order to create a more sustainable workplace or more sustainable built real estate assets, etc. too. And so without giving my own age away, I've still got about 4 decades to go before I can collect a state pension.
That's a shame because that was a poll question I'd arranged for that. That's okay.
But I've got many friends who do work in private equity and real estate and various other finance, and so we have lots of discussions, and I always try to encourage them to say, could there be opportunities essentially to look at new tools essentially that will help you get better at your job, and do you want to outcompete your colleagues, outcompete your competitors too, right, and make you faster, more efficient in your doing your job. And I think now I think going back to the point about culture, that's really what I think leaders of any leading company, any real estate company in this context, should really be fostering as well a culture whereby you're looking at empowering essentially other people in your organization, what to choose the right tools that fit their work, that are essentially bringing more efficiency to the organization, and also giving the learnings and the research and the space to understand, what are many of the practical solutions that a company can implement in order to create more sustainable output. Be it in their day-to-day workplace, or be it, for example, in the real estate projects that they're working on.
And that's largely the S, right? In ESG, because I think people do struggle with what the S means. They all know environment, we can measure that. Governance, we know what that is. But I think S, I don't know, Christiane probably can tell us a better definition of what the S is, but I think people do struggle, like the funds, on how you define that, how you measure that.
Yeah, exactly. So because it's like you said, you cannot use technology to define the S. So it's basically based on culture, you need a common understanding of values, and it's an ethical decision. So it's only about human rights standards. It's about labor protection, and I think the S is going to be equally important as the E. And you also see that the Platform for Sustainable Finance published its final report on the social taxonomy. And the approach there is also different to the environmental taxonomy, and it's now based on a stakeholder assessment. So that's basically looking at the stakeholders, then you can define also the S in the G.
And in terms of the, let's say you take that then to the next level. If you've got, you've got the investment capital more focused on ESG and purpose-driven investment, social impact. Does that mean that the asset managers are then going to actually be needing to look at who their tenants are? In order, as you get more regulatory, as you get more regulation, you get more transparency. That then begins to drill down to, okay, well, I'm letting this building. So what's my judgment going to be? Is it going to be, can they pay the rent? Or is it now going to be, can they pay the rent? And are they the right sort of people that meet the requirements of the people in my fund to be letting this space to? Is it going to go to that route?
Definitely going to that route. We already see that. We see that also demands from tenants that request that if it's a multi-tenant property, also some tenants make requirements what the other tenants are, and then you look at the business happening in the specific asset, but you look also at affiliated companies.
I have a friend and a mentor who runs a leading ESG data reporting solution and software solution, and he made a comment once that, being a former investment banker and asset manager himself, the future of asset management is data management, and that asset managers will become data scientists in the future too. So collecting that information and therefore being able to report that information, of course, is really important. But I think going back to the S view and really more of probably a social point as well, is that we know that there are certain technologies that will improve the sustainability of real estate assets. Take solar panels as an example, right? I mean, everyone should know what solar panels are. Everyone should know that they're built of PV cells. But then if I ask anyone in the room, including myself, like, what are solar PV cells actually made of? I don't expect anyone here to be able to kind of give an answer. If I compare that to a Big Mac, for example, whether the basic ingredients are going to a Big Mac, I'm pretty sure everyone can have a pretty accurate guess. So So one thing is actually understanding, I think, the technical frameworks of what is ESG reporting. But I think another thing is actually, like, a lot of us actually, I think, lacking the basic understanding of, what actually goes into renewable energy sources, goes into battery management. We've maybe heard of lithium batteries, for example, but there's actually many types of lithium batteries, each with their pros, with their cons, in terms of how much energy they can retain, in terms of how much power they can power. Tesla cars are changing, for example. So if you buy a Tesla, for example, later this year, there'll be different batteries compared to earlier, meaning acceleration will be different, meaning that energy storage will be different as well. I think once we have more understanding actually of these, like, very, very crucial technologies that underpin green power, then I think actually we can have basically a more human conversation rather than just talking about technical ESG data points or very, very technical engineering, chemical points as well.
I had a question actually just for Thomas, just like hearing, no, only because
I'm
hearing all this technology, right, but we just talked about inflation and this comes at a cost. Like if you're going to refurb a building for whatever purpose, or you're going to build a building that ticks all the boxes, it's quite expensive, some of the technology to put in, because some of it's quite new as well. And then you've got that conflating with cost of construction. So do you reckon it's going to slow down? Like, I mean, I know it can't slow down because you've got the regulation, but it's kind of a bit of bad timing here. Like, there's a few things.
Absolutely, and that's the key, as Christiane said. Hopefully, the EU regulator will not push back some of the things, because there is pressure on the system saying, look, we will have an economic slowdown in general. Then you have, and on top of that, you will have more and more regulatory frameworks on ESG. That's a stretch, but hopefully they will stand, because you can also see that as an opportunity. I had an interview with a German newspaper some weeks ago where I said, look, the ESG and the CO2 reduction on the asset level must be supported by subsidies and everything, and because there is the CO2 pricing, the market is not able to price it. But now, having this significant increase in energy price, we have a market instrument that works, that should push every owner into the situation where it makes also economically sense.
Yeah.
So we don't need any subsidies anymore. So there's also some good news from this energy increases, and we should use all this moves currently, and see it as an opportunity, as a significant push, and to reduce the energy intense assets more and more, and bring it on the green agenda. And not saying, I complain now the energy prices are so bad, and it's an opportunity.
But if energy prices are the key driver for inflation, then every country should be pushing for energy independence, really,
Exactly.
right?
Exactly.
And therefore looking at different ways to for example, in this country, solar energy in the south, wind energy in the north.
Yeah. You can't
Improvements in the
solve
grid
it in
energy.
a year, or it's nothing, but it's a trend we should use as an additional opportunity to really do significant change, and really do it, and not just talk about it.
And does that mean that there's going to be more of a focus on strategies that are, we've already seen it, but is that going to accelerate the focus on real asset strategies, which include infrastructure, particularly with those crossovers now with renewable energy and those kinds of things?
Exactly, that's a trend we have seen in the last years already, that I always mentioned the garage and data center. It's something, is it real estate, is it infrastructure, but also looking at the smart cities. Yeah, if I look out of this beautiful skyline, I can see all these assets should work together. There's one asset less used. There's energy surplus, which could be transferred to the other building, and we should combine it. I have to combine it in future with the transport logistics, which is infrastructure, with the energy general infrastructure pieces, with real estate. So there are more and more crossovers coming, and it makes sense to have a generic view on that. Especially smart cities, the growing city, because the urbanization is still there. Had some discussion at the beginning of COVID, if COVID now turned back the urbanization trend, it's not there. We will have further globally some further urbanization, and that's something where we have to work on. And London is a good example. I think there's some good things, good combinations. But if I look at some German cities, or other European or global cities, there's so much room where we can improve.
I think also just one thing we haven't touched on is the weight of unallocated capital at the moment in these funds, and that is an absolute reality. So a lot of funds have to deploy capital, and that's the bit of a dilemma between, I think there is a bit of a lack of supply, generally speaking, because of opportunities not being brought to market, or we've talked about some of the challenges. But it's, they do have to allocate. It's kind of like use it or lose it. So I think there's a lot of money chasing the really good opportunities. And I'm coming back to your point about crossover. So we've seen infrastructure funds recently buy into student accommodation. Now that would necessarily not have been infrastructure in the classic way, but you can see how maybe social housing becomes infrastructure. So people are kind of broadening classifications because they need to deploy the capital. And again, I think that's probably what will continue to drive investment despite inflationary costs, because there's a deployment of, we need to deploy capital. And I think in the residential sector, just probably across Europe, definitely here, affordability and lack of supply ultimately will still needs to be built. Things still need to be built, housing, etc. But I think we just, there's a number of different pressures, I think, at the moment.
Okay, good. Does anybody have any questions that they wanted to ask? Feel free to shout if you do. I've just got a kind of last one because I want to make sure that there's time for everybody else to have a coffee and a catch up afterwards as well. But I suppose looking at if we look at these kind of key trends, where we're going, where do you see as the main challenges and the main opportunities? Looking at these at the moment, and you can choose whether you do both the challenge and an opportunity, or whether you do one, whichever is up to you. Christiane, let's just start with you then.
So it's the complexity. So with the regulatory point of view, the stakeholder demands, and to kind of keep track on that. So that's maybe the challenge, and the opportunity. I think you mentioned the existing building stock. That's going to be key, to meet also the CO2 targets and everything. So that's where the opportunities are.
Great, Kingma.
I think from a development and construction perspective, then there's a huge amount of opportunity for the infrastructure, the energy, the utilities companies to be able to invest and deploy more into technologies that are doing carbon capturing, for example, or distributing energy in a more efficient and balanced way. I think from a real estate investment perspective, when we talk about environment, we really talk about energy efficiency. We talk about what are the inputs to energy and what are the outputs in terms of greenhouse gas emissions as well. And so again, I think there's a huge opportunity to invest, retrofit into existing buildings, looking at what are the energy management systems in place, and therefore evaluating what are the solutions there to be able to use more sources of green energy and to be able to emit less heat energy.
And I think the opportunity actually with SFDR and ongoing regulation is to provide that transparency to investors and be able to use it to develop new products. So I think there's a real opportunity for innovation, whether that is the products that you're coming in as part of your funds, whether that's a tech solution, whether it's ESG solution. So I think it's all good actually. I mean, I know we've got some bumps in the road, we've just spoken about them, but I think the long-term view is we've got to keep moving in this direction. We've got to keep getting more sustainable, and I think that's the way we'll move forward.
Yeah, I think number one opportunity will be startups focusing on this transformation part, digitization in combination with ESG. I think that's why VC is good, and the other piece on the asset side, it's a 90% of existing stock that has to be transformed. I think that's the second big opportunity where we can spend a lot of money, but of course we have to renovate, we need the material, we need control over construction costs. That's the challenge coming with that.
Great, really interesting discussion. Thanks to everybody here in the room. Thank you to everybody who's been following this online. And if you're watching it on demand, thanks very much for watching. But we are in person, so rather than just doing a clapping emoji, we are actually able to say thanks very much to everybody for being here and part of the discussion. Thank you.